Good morning. I want to welcome everybody to this Farm Credit East Knowledge Exchange webinar on the dairy industry, in which we're going to talk about and review the 2014 Northeast Dairy Farm Summary, then talk a little bit about the current situation in 2015, a little bit about the outlook and where we find ourselves in 2015. We have two presenters today, and I will introduce one of them in just a second, and then hold off on the introduction of the second one to a little bit later. Let me go down through a couple technology things with everybody. All attendees on this webinar are muted throughout the presentation. So that your screen doesn't fall asleep, move your cursor every now and then to keep it live. There will be time for questions at the end of both presentations. So we're going to run through both presentations, which will be about probably 45 minutes in total. And then we will open it up for questions. You can text chat your questions in. If you look on your screen, you see that red arrow up there. You can expand that and then text your questions in to us, and we will read them to the presenters again after the end of both of the presentations. We really appreciate everybody's attendance today. We find ourselves in a very interesting time in the dairy industry. We come up a year, 2014, of very strong financial returns, and we find ourselves in 2015, almost mid-year in, as a very, very difficult year financially in the dairy industry. So I certainly encourage folks to ask questions as we go along today. We're going to start off with a review of the 2014 Dairy Farm Summary with Chris Laughton, and then we'll ask Bill Zweigbaum, one of our consultants, to then kind of react to that data and talk about 2015, what he thinks some of the key drivers are, some of the key issues are as we find ourselves in May 2015 now. With that, Chris Laughton is Director of Knowledge Exchange at Farm Credit East. He edits the Northeast Dairy Farm Summary book that we produce. Of course, the data comes in from hundreds of farms via loan officers and relationship managers in Farm Credit East. Chris has his bachelor's from Cornell University, his MBA from the University of Massachusetts, and he's co-authored and authored a number of different publications on behalf of Farm Credit East. So with that, Chris is going to walk us through the 2014 Dairy Farm Summary. Chris?
Thanks, Bob. And welcome to everyone online who's attending this webinar. I'm going to begin by talking about the results of the Northeast Dairy Farm Summary. We're going to look at some trends over time and hopefully share some takeaways from the data. To start, a little bit about the Northeast Dairy Farm Summary. Started in 1979, the DFS, or Blue Book as it's sometimes called, is a summary of actual financials from Northeast dairy farms. It allows us to get beyond estimates and projections and see real-world estimates at the farm level, real-world results rather, at the farm level. This year, once again, we had excellent participation from producers of all sizes throughout our service area who allowed us to compile their data to create this benchmark. We had 368 farms participate from 6 Northeast states. Any way you look at it, 2014 was a remarkable year for the Northeast dairy industry. Certainly things have changed significantly in the last 6 months, and we're now facing a serious downturn, which we will talk about later in the presentation. But if we look at 2014 as a single point in time, it was a very good year for dairy producers. On a per cow basis, profitability more than doubled from $490 per cow in 2013 to $1,176 per cow in 2014. This was, of course, driven by a significant increase in wholesale milk prices. The farm gate milk price increased by $4.22 per hundredweight to $25.52. However, cost of production rose as well by $1.30 per hundredweight, which prevented producers from realizing the full benefit of the higher milk prices. That wasn't such a big deal when milk was at $25.52, but more importantly, this is going to be a significant issue going into 2015 now that milk price has dropped significantly. So rather than just repeat the contents of this year's Blue Book, which people can read for themselves, we're going to look at the data in different ways, including over some multi-year time periods. This chart shows the net margin in dollars per hundredweight through the 2000s. The blue line is milk price, the red line is cost of production, and the vertical lines show the net margin per hundredweight for each year. As you can see on the left-hand side of the chart, in the early years, from 2000 to 2006, we saw relatively modest producer margins. In the later years, as we move across the chart to the right, we see significant volatility in milk prices, as well as an increase in cost of production. While average margins have increased, so has cost of production. 2014 saw a record $4.75 margin, topping the previous record from 2007, but a steep decline in milk prices so far in 2015, which you can see on the right-hand side of the chart, raises concerns for margins going into this year. This chart shows the net earnings per cow from the beginning of the DFS in 1979 to the present, on both an actual basis as well as an inflation-adjusted basis. Note the dramatic surge in volatility beginning around 1997 and accelerating in more recent years. If we put a trend line in this chart, we can see that although volatility has increased, so have average net earnings over time. Producers who are able to weather the ups and downs of the current dairy markets and have good risk management strategies may have higher earning potential than in the past. With increased volatility and risk comes increased reward. This may be a tough concept to sell in a down year, but without the market fluctuations, we may not have seen the kind of highs we saw in 2004, 2007, 2011, and then most recently in 2014. If we shorten this time frame and look only at the period from 1993 on, we can see the dramatic increase in volatility during this period. Breaking this down into two periods, 1993 to 2003 and 2004 to 2014, we can see a significant market shift. In the first period on the left, we can see that volatility, while higher than what we experienced in the 1980s, was still relatively modest. The horizontal blue bar represents average net earnings of $162 per cow. The standard deviation is a measurement of volatility. It tells us the degree to which earnings fluctuated on either side of this mean or average earnings. In this case, the standard deviation or average degree of fluctuation was $150 per cow. This means that while the average earnings over time was $162 per cow, in any given year, the actual earnings were likely to be as much as $150 above or below that average. If we now look at the right-hand side of the chart, we can see that average net earnings, represented by the horizontal blue bar, is significantly higher than for the previous period. But look at the tremendous variation around this average. The standard deviation increased from $150 per cow to $410 per cow. That means that while over time producers earned an average of $451 per cow during this period, at any given year the actual earnings will vary by over $400 per cow and could be as much as $1,000 per cow or even a net loss. So while average earnings have increased, risk and volatility have increased dramatically as well. Is this the price of admission to higher earning potential? This means that a producer needs to be prepared for almost anything in terms of earnings going into a new year. This decade has produced results ranging from record profits to nearly catastrophic losses. While there have been improved earnings over a multi-year period, this fluctuation in earnings represents serious management challenges and tests the ability of even top business managers to plan and execute strategy over the long term. For farms that are on the edge or struggling financially, the repeated industry downturns have been very hard to deal with. But let's look at the differences between these two periods in a different way. If we smooth out the ups and downs and just look at overall average return, we can see a very clear difference in profits over these two periods, despite the volatility. In the chart on the left, we can see that average earnings on a per cow basis more than doubled. And if we look on the right, we can see that average return on farmers' equity has risen by nearly as much. So if producers have been earning more, where has that money gone? Well, largely these earnings have been put back into the business itself. With increasing mechanization and input costs, the industry has become more capital intensive, and farmers have been reinvesting their earnings at an increasing rate in property, plant, and equipment. We can see in the chart on the left that capital purchases per cow have steadily increased over time, with a significant jump in 2014 as producers reinvested their earnings in the business or embarked on expansion projects. They have been using earnings to repair and maintain their equipment as well, as we can see on the right-hand chart, particularly in 2014, which was a good year to fix the roof on the barn, overhaul the tractor that may have needed it for some time, or catch up on other deferred maintenance. So we can see a steady trend in both capital purchases and repairs and maintenance per cow during the period 2009 to 2014. Notably, one thing that farmers have not been doing with their increased earnings, at least on average, is spending it on themselves. As you can see in the chart on the left, for the past 6 years, family labor has remained relatively flat at about $150 to $180 per cow. Notably, it showed no increase from 2013 to 2014, despite the significantly increased earnings. Instead, producers have wisely used 2014 earnings to shore up their financial position going into a year, that is this year, 2015, that had been widely predicted to be far less profitable. The chart on the right shows the current ratio, which is measurement of liquidity. It compares the business's current or short-term assets to its current liabilities. Note the significant increase in this metric in 2014 as producers paid down things like accounts payable and operating lines of credit and invested in things like prepaid expenses, inventory, and cash reserves to position themselves for the coming downturn. This 2014 current ratio of 3.7 means that the average dairy producer had 3.7 times more current assets than current liabilities, a very healthy economic position to be in. As previously mentioned, dairy farming has become more capital intensive, and producers have largely used their earnings to reinvest in their business rather than take personal draws. This chart shows that over the past 6 years, while liabilities or debt has remained relatively flat at $3,200 to $3,300 per cow, average farm assets have steadily climbed over the same period, from just over $10,000 per cow in 2009 to nearly $14,000 per cow in 2014. Now shifting from looking at multi-year trends to just looking at 2014 results. This table shows the distribution of results in our 4 size categories that we use in the DFS. Those size categories range from fewer than 100 cows, 100 to 300 cows, 300 to 700, and more than 700 cows. While earnings vary significantly from one farm to the next, when averaged out, we do see a correlation between farm size, efficiency, pounds of milk sold per cow, cost of production, and ultimately profitability. As a group, the large size category, that is over 700 cows, was the most profitable on a per cow basis, most productive on a per cow and per worker measure, the lowest cost producer, and the most efficient user of assets. It is interesting to note that the least profitable group is not the smallest one, but those between 100 and 299 cows. Farms with less than 100 cows are often able to use primarily family labor and save significantly on higher labor costs. So if we look going from the left-hand side of the chart to the right, we can see the metrics improve gradually with each size category. Particularly note milk per worker basically doubling from the less than 100 cow size to the 700 plus cow size. When we separate our sample into quartiles based on per cow profitability, it is interesting to note that farms of all sizes are represented in the top profit quartile, indicating that success is dependent on management, not just scale. Note the top group average number of head is actually slightly lower than the average or bottom profit group. The top profit group contains farms of all size categories, but it's most heavily populated with farms at the top and bottom of the size distribution. It turns out there are quite a few highly profitable small farms, which drive this number down slightly. One trend that we have noticed is that the spread between the top and bottom profit quartiles generally runs about $1,000 per cow, whether it's a good year or a bad year. When average net earnings are less than $1,000 per cow, as they often are, that means that the bottom group usually loses money. But it shows the importance of management in influencing earnings, both in good times and in bad. The distribution difference between the bottom and top profit quartiles is often greater than the difference in profit from one year to the next. There are a few differences by region. If we look at New York compared to New England, the biggest difference is seen in feed costs. While most expense items are just a little bit more expensive in New England than New York, feed costs were significantly higher at $326 per cow. New York farms often have more acreage and produce more of their own feed. Plus, freight costs for purchased feed are usually less in New York as there is so much more grain production in the area. Several New England states do have support programs for dairy producers, most notably Connecticut, Massachusetts, and Maine. However, even taking those into account, the net cost of production is still nearly $2 per hundredweight higher in New England than in New York State. That's reflected in the net earnings per cow, which you can see differently from New York to New England, and the return on assets. Here are a few selected cost categories, highlighting differences between 2013 and 2014. The top line is feed. While feed costs didn't increase very much, it was surprising to some that it increased at all, given the steep declines in grain and oilseed commodity markets. It remains by far the top expense for a dairy farm. Labor was up significantly, 11%. Several Northeast wages and a booming job market have exacerbated an ongoing shortage of agricultural labor. The average number of cows per worker was down slightly, indicating that some farms increased their staffing levels, but mainly the increase appears to be due to higher wages paid to workers. Repairs were also up significantly. Many dairy farmers decided to use their increased earnings in 2014 to catch up on deferred maintenance that had been put off in more lean years. Depreciation was up as well, reflecting new equipment purchases. Hopefully these improvements and investments made in 2014 will enable producers to reduce their repair and maintenance expenditures in 2015 in order to cope with the lower milk price. It is important to look at these expense items because these are some of the key areas that producers will need to economize on as we enter a period of lower margins in 2015. This chart shows the distribution of net production of individual farms in the DFS. We often talk about cost of production as a single number, but it's important to realize that when we talk about the average, that each individual farm really has its own cost of production based on their individual herd and cost structure, and that they vary widely. We can see in this bell-shaped curve that while the average cost of production came in at $20.77, the majority of farms had different costs of productions that ranged anywhere from $18 to $25 per hundredweight, and if we include outliers, they range significantly wider than that. This shows that while milk prices were significantly higher in 2014, some farms still struggled to make ends meet given their higher cost of productions. If we look at expenses and split them into variable costs, or cost of goods sold, that is, costs directly linked to production, and overhead or fixed costs, those that do not vary directly with production, we see a divergence. Overhead costs, things like insurance, property taxes, and utilities, haven't changed very much over time on a per hundredweight basis. In fact, in the last 20 years, they're basically flat. In contrast, variable costs, things like feed, labor, and crop expenses, have increased dramatically over that same period. If we break it down further and look at 1993 to 2004 as compared to 2005 to 2014, we can see a split where the rate of increase has accelerated. One significant takeaway from this is that it's tough to grow out of these price increases. Increasing your herd size will dilute overhead costs and make them lower per hundredweight, but variable costs are much harder to gain scale efficiencies in, as they tend to directly increase with increased production. This means that for farms that may be realizing satisfactory returns, they really need to take a hard look at their cost structures and variable versus overhead costs. If their variable costs are above industry average, expansion may not be a cure-all for low margins. Another takeaway from this chart is to focus on the on the areas that really are affecting profits today, and that's variable costs. As variable costs have increased, overhead costs have declined in their importance to profitability. Overhead costs do matter, but it's increasingly in managing cost of goods sold efficiently where the money is made. So to bring us to some takeaways from the 2014 Dairy Farm Summary, 2014 was a well-deserved great year for Northeast dairy producers who have weathered some serious downturns and who will continue to do so given the increasing fluctuation in milk prices. Profitability rose in 2014, driven by high milk and to a lesser extent high beef prices, but so did net cost of production. A question remains, will producers be able to tighten their belts enough in 2015 to push that net cost of production back down, or are these higher costs permanent? Net cost of production has increased significantly in recent years, driven mainly by increases in variable costs, especially feed costs and labor. Another takeaway is that producers largely reinvested their earnings in 2014. They used their profits for capital investment, repairs, and shoring up financials. This will help them in a big way dealing with the current serious downturn in milk prices that we're facing today. Finally, while volatility has increased, so has long-term profitability. There is profit potential there, but it comes at a price of having huge swings in earnings from year to year. So with that, I'll turn it back over to Bob to introduce Bill Zweigbaum, who will go over some reactions to this data and talk about the 2015 outlook.
Thank you very much, Chris. Very concise overview there. The PDF, hopefully everybody on this call has received that by email this morning. The report itself is at the printers right now and will be available. And anybody who wants a hard copy of that, please just shoot us an email and we'll make sure you get that. But again, you should have the PDF version of the Dairy Farm Summary already. With that, let's go to the next part. Chris did a great job of providing the overview of 2014. No surprises, I think, to most of the people listening as to the overall numbers there. We knew it was a pretty darn good year throughout most of the year as we went through it last year. Our next speaker is Bill Zweigbaum. Bill is a senior consultant with Farm Credit East. His consulting practice focuses on business diversification, farm transfer, expansions, and profit maximizing strategies. He is coordinator of our Success Strategies Dairy Benchmark program. He's a certified agricultural consultant, got his master's from Virginia Tech, Dairy Science, his bachelor's Clark University. He writes a lot, does a great job doing that, is a great presenter. So with that, let me turn it over to Bill to give a little overview of 2015, what he's seen, what some of the factors are, the key influences are this year. So Bill?
Oh, thanks, Bob. Good morning, everybody. I'm going to take just a minute here to reiterate a couple of the high points that I think really bear paying attention to from Chris's analysis of 2014. He spoke about the increase in net cost of production and the fact that we did see it go up last year about 7%. In a year when we had a consumer price index inflation rate of just about 2%. He's already highlighted for you some of the line items that went into play there, and my feeling is that several of those items, notably labor costs, feed costs, and energy costs, will be a little bit lower this year, as we've been experiencing what some economists would call a commodity super cycle, and we've seen some downturns in commodity prices, which includes milk price. So all in all, this idea that net earnings improve with extreme volatility is an important thing for us to understand, but perhaps more importantly, is that we need to be working with producers to help them position themselves well to withstand this extreme volatility and do the right things with the cash that they have in the good years so that they can weather these more challenging years. So some of these things, need to be thought about in terms of, 5 years or more for a planning horizon. It's very hard to convince farmers that volatility is their friend, and we've got to keep talking to them about what are the appropriate levels of capital expenditures, what can they do to make themselves more liquid to get through the down years and that sort of thing. That said, our farms are going into 2015 in pretty good shape. There was a lot of deferred maintenance that got caught up. We did see a lot of spending on capital, which should help reduce 2015's repair costs as well as improve efficiencies. I suspect we'll see labor tighten up a bit as well. I think a lot of our farmers used the additional money that they had available to them in 2014 to release a little bit of pressure on their employees and utilize staff to do some of the catch-up work in-house. And the other piece that I would like to reiterate is this whole discussion about gross margin and looking at cost structures from both a variable and overhead point of view. Chris had some great graphs there that showed this, and I think what we need to really be doing is looking at individual farms to see what their specific cost structure is, because while averages are all well and good, they don't apply to each and every farm. And we do see farms that go to both extremes with very good cost controls, sometimes coupled with high overhead, which would indicate perhaps that those farms are operating under capacity. And vice versa, we do see farms that have their overhead well controlled, but do not have variable costs or cost of goods sold well controlled. And there are very different strategies that you want to use with those farms as you move forward into planning where they're going to be for the next 5 years. So that's kind of my quick reaction to what happened in 2014. It is all history now. I'd like to move on and talk a little bit about what we see in 2015. So I'm going to address what the outlook is for the markets this coming year as best as we can foresee them, and talk a little bit about some of the national, international, and also local conditions that will have an impact on us at Farm Credit East. So we've had 5 consecutive good years. It's allowed for a lot of capital spending, and that capital spending has been pretty well deployed. We've seen growth. We've seen people make improvements to their farms. We've seen some real technology advances incorporated into the farms. We've seen a lot of land purchases as people try to secure their land base and rely a little less on rented land. And for some of our farms, we've also seen some reduction in debt and building of liquidity. The real question is, after a 5-year party, how bad is the hangover going to be? And so I'm going to talk about what the milk price outlook is for this coming year. I'll talk a little bit about cycles. I'm going to talk about the impact of China, the impact of the Russia-Ukraine situation, a little bit about the larger global dairy economy, which is driven by the major players outside of the U.S., would be the Oceania region and the European Union. I'm going to make a few predictions about where I see milk price going and then I'll talk a little bit about risk management strategies and how we need to be conveying some of those thoughts to our farms. So we've seen 3-year cycles now for about the last 20 years. There's no guarantee that the 3-year cycles will continue, but there certainly seems to be a pretty good history that says that that seems to be the way our commodity market is working. On the supply side, we've seen a lot of increasing production this year. The Oceania region is pasture-based and very weather-dependent, New Zealand being the bigger piece of that puzzle. And if you think about where we were in 2013, New Zealand was down 12% in their milk production in the first half of the year as they were a little droughty. And then in the second half of the year, up 5.5%. So you can see that there's a lot of volatility in their milk production, and because they are the major driver of the export markets throughout the world, this has big impacts on our domestic milk prices as we've become more and more involved in relying on exported dairy products as part of our pricing scheme. In 2014, New Zealand was up 10% for the calendar year. So that started to build some real strong supply inventories. And then in 2015, they began trending down in January as they started to get dry. Now remember that Oceania is in the southern hemisphere, and so their seasons are opposite of ours. So for us entering spring here in May is the equivalent of them entering the late fall, and their pastures are starting to run out now. And they are very heavily seasonal, producing only about 10% of their normal milk levels during their winter months. The European Union is also a large player in this market. The big news there is that quota ended on April 1st of this year. Some of those farms had already been ramping up in anticipation of the end of the quota system. However, there was also some backlash there as there were predictions that a couple of countries were going to go over quota, which would have imposed very large fines on their farms. And so they did pull back a bit in the late fall and the beginning of 2015 to make sure that they did not impose those super levies on themselves as they exited the quota system. The other piece of the puzzle there is that the plant capacity has lagged a bit, particularly with smaller plants. They have been 31 years under a quota system. So those plants were designed to operate at a given capacity without much thought given to future expansion. And some of these smaller processors have had to impose their own restrictions on the farms that ship to them just for lack of plant capacity. And the other part of what happens in Europe is that dairy farmers in Europe tend to be quite diversified, and they like diversification as a risk management strategy. So there has not been a great deal of excitement about really ramping up dairy production in the European Union in 2015. Particularly fortunate for us in that the milk price started declining prior to the end of the quota system, and those farms recognized that ramping up was not going to be profitable in the short term. So I've talked now for a couple of years about how it looks like price cycles will continue with somewhat reduced volatility. Now you remember Chris showed graphs of volatility with 2 decades that had very different levels. And while I don't think we're going to immediately go back to the low levels of volatility that we saw in the 90s and early 2000s, I do think we're going to see volatility come down at a decreasing rate, so that we probably will not have the $9 and $10 swings that we've experienced recently, all things being equal from market conditions. Back in April of 2014, I had estimated a $5 drop in milk price through the summer of 2015. The reality has been that we've seen over $8 drop in both Class 3 and Class 4 prices in that same time period. And farm level prices are probably going to be down $6.50 to $7 compared to 2014's average milk price. Now that's an awful lot of ground to make up. $6.50 or $7 is much more than our average profits for 2014, which means we've got to chase after some serious cost controls in order to narrow up those losses that we are anticipating for 2015. For the next 12 months, it looks like we've already bottomed out, so we should see some modest price increases going forward into May. I would anticipate somewhere between $1.30 and $2 increase in the on-farm milk price by the end of the year, as opposed to the bottom price that was just received on farms. So not a lot of recovery, and it will be rather slow unless conditions change. That means that we can expect average gross milk prices for 2015 in the $18 to $19 area. There will be some regional differences. There will also be differences based on component tests and quality premiums. I like to remind the farms that I work with that the components and quality portions of their milk check are controllable on the farm level. By the end of the year, I think we will probably just be hitting the $20 mark. So the indications are that we'll have slower volatility and a very long recovery period through this next cycle. China has talked about an awful lot in its influence on the world economy, and it's been a very influential player in the dairy markets the last several years, really since 2008. In 2014, they increased their purchasing of dairy products just in 1 month to a level that was more than their entire annual purchases in 2013. So they are a big source of volatility to the markets. As prices increased, their purchases declined. They built a fairly large inventory at somewhat relatively lower prices that we saw in 2013 and early 2014. The other thing that came into play is that in 2013, China's domestic production had decreased 7% through a variety of conditions that had to do with both forage quality and a shift in the overall infrastructure of the Chinese dairy industry as they have moved towards consolidating small farmers into group-operated large operations. In 2014, they overcame the majority of those challenges and increased milk production domestically by 8%. Again, another source of strong volatility to the international market. As I said, their import demand was very strong in late 2013, early 2014. But once they ramped up their domestic production, along with the fact that they had large inventories built, they did end up in a market surplus with some anecdotal stories of milk dumping actually occurring on some small farms in China at the end of 2014. One of the things that's still going for us as a primary exporter to the Chinese market is that the more affluent Chinese consumers do prefer foreign products because there are still lingering safety concerns that revolve around the melamine scare that happened 6 years ago. In addition, China has a growing and increasing urban middle class, and that middle class is consuming less than a third of the average global per capita milk consumption. So there's a lot of market potential still untapped in China as they develop a great taste for dairy products. There has been some reported heavy culling and elimination of small herds in China over the past year. And again, there is a push at the governmental level to try and consolidate farms into larger units. One of the biggest problems in really understanding China's influence on worldwide markets is that all of the inventory data is suspect, and so a lot of the information we have comes from anecdotal information from people on the ground. A year ago, I talked a little bit about what was going on in the Ukraine, and that was the very beginning of the conflict shortly after the first airliner was shot down, and things were very unclear. At that point in time, a year ago, even though there were no seaport disruptions in the Ukraine, which is a fairly significant grain exporter, corn prices had increased 10% in that 30-day period through March and early April, based on concerns that it could happen. In the meantime, in the next 12 months since that started, several countries have tried to put some political pressure on Russia by stopping their exports of dairy products. And the European Union, or what we call the Eurozone, relied very heavily on exports to Russia for a significant part of their product sales, especially cheese sales. And so inventories in the European Union last year grew very quickly after the embargo was started, and that was the beginning of milk price depression for the European Union, which actually preceded the drop in the price in the United States. So as of the end of last month, the quota system is finished. I've already mentioned they like diversification as a risk management strategy for the majority of dairy farms in the European Union. There are some plant capacity issues, and again, that Russian market, due to political reasons, has created a difficult challenge for their exports. So important to remember is that while supply and demand is still the major driver in milk pricing, international politics has a very large external influence on supply and demand as product moves around the world. And so what we've seen in early 2015 is that Germany and France, which are the two largest dairy countries in Europe, are down about 1.6% in their output, and the world as a whole is pretty flat, at down 0.07%, so almost unmeasurable. We also hear a lot about currency exchange rate and the strength of the dollar having an impact on our ability to export to other markets. If you look back at a year ago, the euro was worth about $1.26. Over the last 2 months, the euro has consistently been under $1.10, which makes our products considerably more expensive to other countries, as we are the currency that all conversions are made to for these international markets. Now, the strength of the U.S. dollar is not so much that the U.S. economy has taken off. In fact, we just got a pretty poor gross domestic product report for the first quarter of 2015 with growth of only 0.2% in the United States. But relative to other countries, we are better off. And so because there are weaknesses in other areas of the world, and because there's a lot of trepidation in the European Union about what's going to happen when the next extension of the Greek bailout comes back for discussion, our currency has been very strong worldwide this past year. So supply and demand are still going to prevail, but currency valuations will have a major impact on our ability to export product to other parts of the world. And our export markets now account for about 16% of total U.S. dairy product sales. So it's a pretty large sector that we're talking about. So I said I would talk a little bit about risk management tools. We've got forward contracting, LGM dairy, and MPP all available at this point to our farms, although LGM dairy is pretty much out of money until next October. When we look at our farms that are using all of these risk management tools, what we see is that there are some losses incurred over the long term, but they are not significantly large for farms that continue to forward contract and use risk management tools as an insurance policy. What we sometimes overlook is that we need to be having discussions with dairy farmers about how much risk they are willing or able to take. If they're highly leveraged, it certainly behooves them to use risk management protection against catastrophic losses. But for high equity farms, they may not need to use risk management tools, as they may have the ability to withstand poor milk price years and poor margin years with their own capital. Now, the reason why I bring this up is because we need to think about the cost of risk management tools, both as combined premiums, in other words, the cash paid by the farmer and premiums for the risk management contracts, along with the potential contract losses, which is the non-cash piece. And so those potential contract losses in volatile markets can be quite significant. And in analyzing what happened in 2014, we saw a number of farms who utilized a lot of contracts to mitigate risk in terms of the downside on milk, and because the markets worked against them, their contract losses actually amounted to virtually all of their operational profits. In other words, we saw farms that had operational profits of over $1,000 a cow of net margin, but gave up over $1,000 a cow of milk income because of contracts that were upside down. And so we've got to really think about what are the full impacts on a farm of using risk management tools, as opposed to just talking about the fact that you can consider that contracts to be an insurance premium that may cost anywhere from 10 to 30 cents per hundredweight, because the losses incurred across the entire business can be much greater. The other thing we need to be talking to our farmers about is correcting bad habits that are created during good times. I talked a little bit about the pressure relief that people hired some additional labor in order to get caught up on things and just take the load off on their farms. And now we've got to realize that belt tightening has to occur, and that needs to be applied to other places where excesses may have crept in over time, as we've had 5 pretty good years in a row here. And lastly, I would encourage everyone to think about overcoming emotional reactions, because we did just go through a $10 slide in milk price here in the last 5 months. Overcome that emotional reaction with patience, long-term vision, and budgeting in order to really focus on where their businesses are headed and what their long-term picture looks like. On the local front, I didn't make any slides for this. I just wanted to mention quickly that for federal milk order number 1, which the majority of our producers ship into, beginning April 1st, there's a temporary plant delivery exception, which means that there's an anticipation that there may be some dumped milk over the next 2 months, and that milk under this order will be measured and sampled and included in the pool, and the utilization will be determined by the nearest plant. And that means that there's a market expectation that the balancing facilities will not be able to handle all of the volume that may come at them in the short term. In the first quarter of 2015, Federal Order 1 milk production is up 2.1% year over year. Class 1 utilization down 2.4%, and Class 4 utilization, lowest value powder products, increased 46%. Now that's made Class 4 drop down significantly below Class 3 prices for the first quarter, and when you couple that with Class 1 utilization being down, local milk prices have taken a big hit, more so than they would have based on just the class prices alone. The utilizations have an impact there. Now, on the other side of that, the Chicago mercantile butter and cheese prices actually have been showing a slight recovery in the last week or two. However, the European butter and cheese markets are down significantly, so there's a spread between the U.S. and the European Union that on butter in mid-March was about 10 cents and is now about 38 cents. And this is very similar to last fall when our prices maintained considerably above all the rest of the world prices, and was part of the reason why our export potential diminished so much last year in the fall, and why we experienced such a rapid decline in milk price had to do with the fact that there was a disconnect between our local or domestic prices and world prices for both butter and cheese, but most obviously on the butter side of things. So that's all I've got. So I'll turn it back to Bob now.
Thank you very much, Bill. Great overview of domestic, international, and local market conditions. Really appreciate it very much. I want to remind all the participants on the line, all the webinar folks, please text chat your questions in. You do that by going to that orange or red arrow at the top right of your screen and expanding and then putting in your question. Don't know that Chris can answer this first one, maybe Bill, but question came in: do dairies in the Northeast feed high bypass soybean meal? Bill, are you aware on that one?
I mean, there is some utilization of bypass proteins, but not to the extent that there used to be in years prior, and that's really a nutrition change in the way that rations are looked at now, because there's been a shift to feeding more for the rumen and less for the abomasum in terms of protein content. And it has to do also with the shifting of amino acids in the diet.
Great. Thank you, Bill. Next question goes to Chris. In the other cost category, are energy costs other than fuel in the chart incorporated in this value? That's figure 4B, Chris.
Sure. Do you want to give me, let me show my screen?
Chris is going to pull up the chart, I think, where the question comes from.
You can see it? Okay. Great. Yeah, as you can see here, there's a line item a few lines down for fuel, which is primarily diesel fuel and gasoline. Then there's, if you go down to the bottom of the chart, there's other expenses, which is basically everything that's not itemized above. And that other expenses line does include utilities like electricity and gas, natural gas, and propane. Neither fuel nor utilities are big drivers of price increases. They've both increased only a few percent over the last couple of years. So, you know, over time they've increased, but not recently very much. So that answers that question.
Thank you, Chris. Next question. What amount, this goes probably to you, Bill, what amount of near cash liquidity per cow is appropriate to have if farmers don't want to hit up on risk management too heavy?
Well, we've kind of set a goal amongst the consulting group of $1,000 a cow for near cash. And that should really probably be enough to let them weather most storms pretty well.
Thank you. Bill, another question for you. You teed up some of the changes going on globally, and you specifically talked about the end of the quotas in Europe. What are the long-term implications in your view? Are we going to see some countries 10, 15 years from now basically get out of dairy entirely and other countries see significant expansion? What do you think we're going to see out of Europe given the quota change?
I think there definitely will be differences country to country. Ireland in particular has a national goal of increasing its dairy production by 50% over the next 5 years. And they're looking to become a strong global force in cheese export and butter export as time goes on. So that's a stated goal, and that does present a challenge or a threat to the United States markets because they are going to have a little less expensive transport costs into most of the major buyers.
Bill, the next question goes to you too. It's on your comment about maybe a little bit less volatility. What are the factors that might lead to less volatility going forward? Will the margin protection program result in less volatility?
Well, again, the margin protection program is really a domestic thing that is not going to have a lot of influence on world markets by any stretch. That's really more of a risk management tool for domestic operations to guarantee a bit of a margin there. The fact that some of the risk will be removed by that will tend to reduce volatility in the overall marketplace, however, because the amount of risk and the amount of profit go hand in hand. And so as we have tools that are imposed into the market system that externally manipulate the amount of volatility, there will be some changes.
Thank you. And again, I would encourage anybody to text chat a question in. We were kind of down to the end of the webinar. But a question on labor, Bill. What are you seeing as far as labor availability out there? Are Dairy farms still have a challenge there. Chris noted that labor costs went up over 10%. At the same time, we believe there's some labor efficiencies being put in, and yet we see this significant increase in labor costs. How do you read the current labor situation on dairy farms?
Well, I think that labor is going to be one of the biggest challenges in the next few years. There's certainly been difficulties in hiring, particularly at the entry level. In other words, mostly milkers and entry level outside workers. That lack of pool is certainly going to create some challenges, and it has been, I think, part of the reason we've seen some increases in average pay. But when we look at that 10% increase in labor costs, it's been kind of split between pay per worker and losses of efficiency in the short term. And like I said, I think that's been a pressure release valve that while there was some money, people took a little bit of the pressure off of their existing staff, but I think that will probably ratchet back down here as things tighten up this year.
Okay, thank you very much, Bill. And again, any last questions? I have one more here. Kind of goes maybe to Chris, but Bill, you might want to add into it. What is the trend in income tax paid per cow over the last 2 to 3 years? Chris?
Well, it's increased with increasing profits. Specifically how much, I can't say precisely without drilling down into the data more. But certainly it's varied with the profitability of the industry. I don't know if you have any more specifics on that, Bill.
Yeah, I mean, we've looked at that not in the data set for Dairy Farm Summary, but in the Dairy Benchmark Success Strategies data set, we have looked at that. And income tax has increased a bit, but to be honest, most of our profitable operations have been very aggressively tax planning. So while it may look like a big percentage increase, it's been on, you know, kind of the range of going from paying $8,000 or $10,000 to paying $15,000 on farms that had net earnings last year on an accrual basis of about $1 million plus. So it's not been a big impact. Tax planning has remained very aggressive, and probably the biggest wild card there is going to be what happens in the future with Section 179.
Yeah, Bill, I would reiterate that many producers took advantage of tax strategies such as Section 179, accelerated depreciation schemes, and things like prepaid expenses to mitigate their tax obligations during the high profit years.
I'll just add that the Section 179 legislation continues to pend in Congress now. That would be moving it back to from the current $25,000 level back to the $500,000 level is where it was last year. So that legislation again is pending in Congress. Next question that came in is about the H-2A program. With the Mexican H-2A program, will it increase labor volatility, or is it okay for dairy farms? I believe, and Bill, you can add anything here, I believe that the reference there is a bill pending in Congress that expands the H-2A program. That is the temporary agricultural guest worker program that we currently have in the United States. It's primarily used by fruit farms and vegetable farms. It does not allow for year-round labor. Therefore, most dairy farm jobs are not eligible to be to utilize, or dairy farms. Most jobs on dairy farms are not eligible to be utilized the H-2A program at the current time. There is a bill pending. Congressman Chris Gibson from New York has introduced that along with 3 or 4 other Congress members from New York State. That has not passed at this point in time. That bill does expand the H-2A guest worker program to dairy workers, provides for, I believe, a 3-year rotational period for dairy workers to use the H-2A program. But again, that has not passed at this point in time. The outlook in Congress, pretty tough to say. There are a number of immigration enforcement bills introduced, and the H-2A expansion bill, the proponents of that wanted to make sure that if any enforcement bills, E-Verify, mandatory E-Verify being the major one, if that began to move, that they would have something that could help agriculture. So there's a number of changes made to the H-2A program under the Gibson bill, including expansion to dairy, but also some other programmatic changes, including moving it from the Department of Labor to the U.S. Department of Agriculture, USDA, for implementation. Anything else on labor, Bill, that you would add to that?
Not really, no.
Okay. All right. Probably a longer answer than was wanted. Next question, Bill, or Chris, maybe Chris. After big CapEx spending per cow in 2014, what should we budget as the new normal?
Well, capital expenditures did increase significantly in 2014. They went from the previous, if we look at 2011, 12, and 13, it was around $800 per cow. And if we look at 2014, it increased to about $1,100 per cow. And I think some of that was driven by the fact that farms needed additional capital expenditure, that there had been some purchases that were put off in more lean years. But I think some of that, and you can step in on weigh in on this, Bill, but I think some of that was driven by tax planning as well. So my opinion, and it remains to be seen what actually happens, is that the capital expenditure is going to fall back down to the previous average of about $800 per cow from the $1,100 it was in 2014. What do you think, Bill?
I think that's part of it. Part of it also was improvements in efficiency through capital expenditures, as well as some expansions. And remember that land purchases also go into that figure, and there has been quite a move the last 3 or 4 years here to purchase land a little more aggressively to kind of overcome concerns that some leased property may be lost in the future, and people want to shore up that land base for forage production.
Thank you, Chris and Bill. Appreciate that. I think that wraps up the questions today. A recording of this webinar will be available. It will be available at farmcrediteast.com/webinars. So we will put it out there, and we would encourage anybody to please utilize that and share it with others that might be interested. We greatly appreciate our attendees today being on. Big thank you to Bill Zweigbaum and Chris Laughton for their presentations today. I think we covered a lot of ground today, talking about both 14, about the national, international, local situation in 2015, and just greatly appreciate it. So on behalf of Farm Credit East and our Knowledge Exchange program, I thank all the participants today, and have a great day. Thank you.